Yeah, that works. Yes, lovely. Thank you.
A little bit.
Good afternoon, everyone. I'm Andrea L. Richards. I run an accountancy practice based in Essex. We're called Accounts Navigator. We specialise in management accounts and building people's businesses, as well as your normal tax compliance that's required. Yeah, that's me.
Hi everyone, my name is Samuel. I'm a chartered accountant, the founder of Arthur Hamilton Accountancy and Scale Up CFO in the heart of London. I help founders scale profitably by building financial clarity, turning messy numbers into confident decisions. I'm more than happy to be here. Thanks for having me.
Hello. Hello, sorry about that. I'm Harriet Formby, a chartered accountant and founder of Below the Line Finance, a fractional CFO practice. So I've spent around 15 years supporting startups scale up through early raises, pivots, growth, M&A and acquisitions across tech, retail, creative and professional services. I founded my own business really to work with mostly purpose-driven people who are building things differently. So we make space for the emotional side to money and translate that into financial strategy that supports the kind of business you want to build. So really great to be here.
Hello, I'm Sophie. I'm a fractional CFO and founder of Right CFO, which is a firm of fractional CFOs. It's a group of 8 of us, London-based, and we specialize in helping tech businesses, media, creative services, and not-for-profit mainly. And we've been going for 11 years, and unlike the rest of the panelists, I'm here every month rather.
Wow, that is amazing. Thank you very much. Really appreciate that. Right here, people, you've heard them. We've got 4 brilliant finance people with us today. They're going to be here for the next 15 minutes now. So don't leave it for last minute to ask questions, please. Often when that happens, we run out of time. But once you're getting ready to ask your questions, and by the way, again, another reminder to those of you that have just joined on the live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, we are unable to monitor your questions there. So you'll have to join us here on Microsoft Teams. Quickest way to do that, it's to go to our website, startup2scaleup.club. Scroll down a little bit, you'll find Startup Finances Q&A 08. Click join, it's a quick registration. That gets you a link to your email. And through that link, you can then tune in here to our call on Microsoft Teams. Being audio only means you can join us from anywhere via any platform or device. Now, in terms of some do's and don'ts, if we can think of one each, please, panelists. If we can use different reasoning for the do and the don't rather than the same logic, that would be great. Maybe if we can start with Sophie, Harriet, Andrea, and then Samuel, please.
Okay, so my do is when you are considering hiring a new employee in your business, which a lot of people do when revenue starts to really kick off and think, oh, I need a new head of whatever. Don't just look at the revenue line to decide who to hire. Look at the full cost of that person and bringing them in, and look at your bottom line. So you bring someone in, they're going to cost whatever they're going to cost. Add how much they really cost to the whole company, all the overheads that go with that, getting a new person, and then look at the bottom line and see if you can afford it. My don't is don't spend any time, money, or effort in improving a manual task that can be automated. I think now is when everyone needs to be, in all areas of your business, whether it's finance or other areas. If there's anything that's a bit clunky and it's a manual task, and you want to improve it, find a way to automate it. Yeah, that's it. Those are mine.
It
Who's
is.
next?
I think we said either Sophie and then Harriet, or the other way around, didn't we? And then it was going to be Samuel and last but not least, Andrea. So was it Sophie that just went now, right?
Yes.
Yeah. Harriet, it's your turn. Can you hear us?
Sorry, yeah, I think I just lost connection for a second, and I was
That's
wondering
okay.
what going on.
That's
So yeah,
That's all right.
I would say a do would be to keep iterating, you know, especially in sort of startup mode. You can go tick, tick, tick. I've done my cash flow, I've done my budget, I've done this, and then put it to one side. And I know we're really busy, so that there's lots to do, but keep, you know, going back to the same documents again and again, because so much is going to change so rapidly that you need to keep track of the data, so that if you're in front of, you know, stakeholders and potential investors and stuff, that actually things do reflect, you know, what's actually going on in the business, and that it's, you know, it's up to date and the financials tell the same story. And a don't be afraid to, you know, ask questions. If you've turned up here, that's a really good start. If you're tuning into this, people really want to help, and obviously you can bring people in on a, you know, paid to help you basis, which is great if you can do that. But do, you know, do ask the questions, even if they seem silly, because they're never silly.
Samuel, it's your turn.
I'm so sorry. I thought somebody else was going ahead. So my dues is to definitely get financial clarity when scaling. I'll give you an example. Recently spoke to a client. I told a client they earned £100,000 in profit, but they had been taking around £2,000 to £3,000 in dividends. And the profit they made this year, they were using it to offset their tax liability from previous years. So at the end of the tax year, there was not £100,000 in the bank account, but probably less than £1,000. Having clarity would have allowed him to see the position of the actual business, right? And what's in a bank account doesn't equal profitability. The second thing, my don'ts, which is linked to this, is don't chase revenue for the sake of vanity, but focus on profitability and sustainability of the business. Thank you.
Thanks. Okay, I would say as entrepreneurs, please set aside your money for tax. A lot of businesses making their money and forgetting that at the end of the day, there is a tax bill to pay once you've made these great profits, and that money belongs to HMRC, and they will want their money on time. So please always set aside money for tax, and don't wait until the deadline to do your financial reporting. As a firm, we always encourage people to do it in the early months so that they have plenty more months to make sure that their tax is there to pay it on time. So, yeah, that's from me.
Oh, that's some amazing advice from all four of you, and I really appreciate you for that. Before we go on to our first question, I guess a quick reset of the conversation. This is Startup Fundraising Q&A. Sorry, Startup Finances Q&A. It's our 8th session. We do this on a monthly basis where we seek to help startups like yourselves, in the UK that is, with whatever questions you may have as far as hopefully helping you better understand and successfully manage your startup finances. Those questions can be on anything within that. So whether it's cash flow, budgeting, profit and loss, payroll, employee benefits, taxation, bookkeeping, VAT, auditing, loans, banking, fraud, projections, forecasting, and all that jazz. There literally are no wrong questions, and there's no need to be shy. It's a learning curve for us all. Now, if your questions are on that, all you have to do is just drop your question in the chat. We'll give you the mic, and then you go ahead and ask it. But if you are not on Microsoft Teams and you're on our live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we are unable to monitor your questions live. And therefore you would need to join us here on Microsoft Teams. It's audio only. And the quickest way to do that is to go onto our website, startuptoscaleup.club. Again, it's startuptoscaleup.club. Scroll down a little bit, you'll then be able to find today's session, which is Startup Finances Q&A 08. You click join, it's a quick registration. That gets you a link to your email, then through that link, you can then join us here. And again, being audio only means it's easy for you to join from anywhere via any platform or device. If your questions, however, are not on finances, please save them for the other conversations we run. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of each month, it's UK startup law. And as you can see today, third Friday of each month, it's UK startup finances. They're all from 12 to 1 p.m. UK time. And you can register to any future session via our website, startuptoscaleup.club. And actually, when you go there, why not also join our WhatsApp community? We've got some great groups of founders, investors, operators, and of course, our brilliant panelists and mentors as well. We'll now go on to a few questions. I've put a question in the chat, but I'm quite keen to ask another question, which it's almost a group of many other startups I've come across. And also, most importantly, is quite a few corporates that I speak to, or not, well, not sure if I should call corporates, but quite a few larger companies that often ask me about the best way to invest in startups, especially if it's startups that would sort of provide a need that they have. So just for argument's sake, let's say you are a company that, I don't know, has got a few hundred vets throughout the country or throughout the world. And one of your biggest expenditures at the moment may be, I don't know, compliance, for example. So then you want to invest in a startup that does compliance, maybe through AI or some other form. And you want to do it for two reasons. One, because you want innovation within your own compliance, so kind of satisfy your supply chain. But at the same time, you want to invest some money. Now, are there any good ways of doing that? And are there any massive advantages in terms of tax, or do they have to bear all that burden? My assumption would be that, you know, being an investment, it's probably not the same tax advantage as spending the money for a service. But maybe our team knows a few things that I don't. And again, I'm sorry, because I struggle to formulate this as I probably would have wanted. But shall we start with Samuel, Harriet, Andrea, and last but not least, Sophie? Let's try about a minute each if we can, please.
Fantastic. So, Anton, you're asking, or the person's asking, what's the best way to invest in a startup?
Yeah, so it's, mind you, this is I'm kind of grouping conversations that I've had, and I've been meaning, because every time this conversation comes up, I don't find it very easy to come up with the right answer. So it's various larger companies that want to invest in a startup, but what they really want to do is they want to invest in a startup that will pretty much become part of their supply chain. Does that make sense?
Okay.
So, and they want to know, is that going to be good for their tax return? Or is it something that, you know, they write off and basically it's not like they can can I get anything within tax through that? And two, are there any decent ways of doing that? And again, we're not talking here about the gazillion-dollar companies out there that, they've got armies of tax lawyers and accountants and that. So it's larger companies that are making decent money, that they're not used to this. Does that make sense?
Yeah. Okay. I'm going to try to answer it as best as I can. Okay, so if you're talking about putting money into a EIS or SEIS startup, then it's usually better to invest personally as an individual rather than through a company. The reason is simple. All tax benefits like the 30 to 50% income tax relief and capital gains exemptions on those two schemes are only available for individuals, not companies. However, when you invest through your limited company, you can't claim those EIS perks, but you can treat it as corporate investment.
That's exactly what I'm trying to get to. So in terms of corporate investment, so forget the personal investment, but again, corporate investments, trying to hit two birds with one stone. Number one, in terms of benefiting from that investment as a supplier. And two, of course, making an investment that may give a return to the LTD.
So in terms of investment as a supplier, I think one of the things you do when investing in some of these startups is, in most cases, unless you have an agreement on ground, you have to remember you are just an investor. And in most cases, you don't have any control over the business at all, right? So if they have an existing supplier that they're happy with, unless you want to exert your influence, but there's nothing there that automatically assumes that that's going to be the case, right?
No, that's true. But I'm sorry, Samuel, because I think it's my fault because I'm not explaining this extensively. So the idea is that when you're a startup and there's a larger company that says to you, look, I would love for you to supply me this service, then you've hit jackpot. Because one of the hardest things is getting to market all those early clients.
Okay.
So in that sense, so what I mean is the startup to provide their service or product to the said organization that invests in them. Are there any kind of legal things, legal measures that say you can't do that, one? And two, is that beneficial to the corporate that is investing? Have you come across anything like that?
There's nothing
in terms of tax and so on.
Of course, from the startup company that's seeking investment, I don't think there's anything in particular that comes to mind. But for the large corporation that's investing, one of the things it does, it shows on their balance sheet as a fixed asset, right? So as the company values increases, so does the large corporation. That's a benefit. And if the startup also pays dividends later, the company also receives them tax-free. So in terms of benefits for the corporations, those are the two ones that come to mind off the top of my head. I hope I've answered your question. I really do so.
No, you have. And again, it's my fault because I don't know. In my head, it sounded like I had the right question, but it just got muddled up. Let's see what the ladies come up with. So I think we said Harriet and then Andrea and last but not least Sophie, didn't we? Ladies?
I'd say, and it might, I don't know if this is quite what you're getting at, but it will depend on how much shares they're buying. They might become like a connected company. So the triggers around this would be, certainly if it's like more than 50% of the, that they're buying out, which I don't know what we're talking about here.
We're talking here minority shares. So just for argument's sake, let's say, I don't know, 10%, right? Because we're talking here about kind of the early stage investment. So if we were talking about 10%, or roughly, what are the advantages for the let's call it the corporate in terms of tax and so on?
So in terms of if it was kind of like 20%, and this is why it might be important to look at the percentages, they're one of the things to consider is they would be like an associated company, so they would need to disclose, depending on what reporting they're doing themselves, that kind of connected relationship, and so there might be more admin to do around that, and in terms of what that might mean for the startup. So I think it's tricky, because sometimes for this, maybe we're assuming they're a UK based company, but that sometimes this can be elements of overseas relationships as well, which will have other tax implications. But I think essentially, if the company is making the investment, it's real. I'd like to. I think it's tricky to say without an actual example and figures.
Let me try. Let me try and paint an example. This is literally one of the main people I can remember asking us this question at an event. They are an insurance company. They have a parent company in the US. They do quite a bit of money. I think they're about 130 mil annual turnover. And two of the main things that they spend money on is compliance and also background checks, which in a way background checks goes within their financial crime / compliance / risk, right? What they asked me was, if we invested in a startup that has come up with a great way of doing this via AI or some other form, one, can we, how attractive would we come across to this startup to also say, look, we're going to invest in you. And when your product is ready, we'll become your first client. Therefore, we would want some kind of favoritism in terms of pricing, as well as hopefully, good terms when we invest in you. So what I'm trying to find out now is, one, how doable is that? And two, are there any advantages, especially when it comes to taxing and so on? Is that specific enough, or?
Yeah, I think there's two sides. Like in terms of the commercial benefit, I think there's definitely pluses, aren't there? Because you've got the startups thinking, great, I've got a partnership with a big company, and now I am able to guarantee some future income, and we've got their endorsement in the industry. I can see from the company's point of view buying it, they're accessing control over their market. I think I'm going to pass on talking about the tax implication, just because I think it's just there's so much in it. I'll let somebody else talk about that, if that's okay.
Fair enough. Okay, let's hear what Sophie and Andrew have got to say about this.
Okay. So, I mean, convoluted, but obviously, my clientele would more likely be the smaller entity. So the insurance company would be buying into them. So for that smaller entity, they would be able to get benefits of access to capital, maybe, without having to go to the bank. So it's a benefit for them in that sense. They could have, it will boost their credibility because they're aligned, working with a bigger corporate. So that will help them in the long run as well. Being aligned with bigger corporates brings better connections and that, which will help grow their business in the long term. So yeah, those are the kind of things that I would be looking at more on the smaller side, rather than for the bigger corporate that's doing the investing and that. But for the small people, it's a great benefit for them because it brings all those added extras. Hope that's helpful.
Thank you very much, Andrea. And last but not least, Sophie.
So I can't really advise on the tax status and how that would be helpful. However, what sounded some alarm bells was, we'll buy into your company and you give us a favorable price, and that, like, I've dealt with this a couple of times, although, well, where there was a company selling to a related company, now they were owned more than 10%, so it was more of like an intercompany, but we had to prove to HMRC that they were selling at a fair price and that they're selling their goods at a market price, and we had to show proof. And that's really important, because if you're connected to a company and they either sell it really cheap or sell it really expensive, it could be like, oh, you're just trying to lower your tax bill in whichever country that person has a lower tax bill, that kind of thing. So you do need to be careful. Where, does that apply if you only own 10%? I don't know. I'd have to look into that. I'm not really sure. But it is something you have to be careful about.
I hear you. Thank you very much for that, team. Right, yeah. Let's go on to our first question that is more specific, rather than me trying to round up questions from conversations we've had recently. This one is on IR35. So, ensuring IR35 compliance for freelancers and contractors. We're a media tech startup producing AI-enhanced video editing tools for content creators. We're based near Brighton. The challenge we have is that our company engages. No, sorry. Oh, okay. Okay, because in the email they sent is our company is about to engage, but for some reason I'll put it here, engages multiple contractors and freelancers, but is unsure how to assess their employment status under IR35 regulations. So we are revenue generating, bootstrapped, and we'll get freelancers to contribute to key projects. So again, the question is, as a media tech startup relying on contractors and freelancers, how can we assess and manage IR35 compliance to avoid misclassification risks and penalties? What UK specific tools or practices such as HMRC's check employment status, tax tools, or contractual safeguards should we use to ensure accurate payroll processing compliance within IR35 regulations? Personally, I would go to an umbrella company if you don't have an accountant or a finance person that you can ask these questions. And the umbrella companies would be more than happy. But if you want proper advice, hopefully our four panelists will be able to come up with something. So maybe we can start with Sophie, Andrea, Harriet, and last but not least, Samuel. Let's try and take about a minute each, please, Steve.
Hi. Okay, so I mean, I'm glad that they're thinking about it, because it is a big area, and it can cause a bit of confusion. And those checklists are right. I mean, that is the first step, to go and look at HMRC checklists. There are things on, I can't think by heart, but there are things like, you don't report to someone. It's more that someone else can do what you're doing, and you've got a specific task list. You don't have, say, company email, or there's certain things like that. Now, I've worked in media for many years, and I've seen this go very wrong. When I was in a creative advertising agency, they use lots of freelancers. And there were several that they kept reusing. So people would come in, they'd work for maybe 2 months, like 5 days a week for 2 months, and then don't work again for a few months. We really thought we were doing everything correctly, and they were invoicing, and there was proper projects and everything that you could identify with. But HMRC disagreed, and there was a huge fine. I can't remember what it was. Maybe £10,000. I can't remember. It was a lot of money, and we had to pay for like you know, NI costs, whatever, and they got hit as well. So if you're using contractors in a way where like they're working on a big project for a amount of time, be safe, I would say, and just put them on payroll as a contracted. If it's bits and pieces here and there, and it's all they're contractors, but it's almost like they're a supplier, then, and you go through that list and you can tick everything off and satisfy yourself that you've gone through the checklist, then it should be fine that they invoice you. But if any doubt, check with an accountant.
Yeah, with this, I would definitely say check with your accountant, but definitely use an umbrella company because they've got all the rules and that's their specialisation, so they should be able to deal with that for you. Yeah, I would address this to an umbrella company and let them deal with it for you. Keep it short and sweet.
My thoughts on it are, in terms of, I deal with quite a lot of sort of creative media type companies that have a lot of freelance people doing bits and pieces and projects and different elements. And there's a whole ecosystem of these kind of, particularly around like creative editing, content creators, etc. They are self-employed and they're probably running businesses self-employed, and they don't necessarily want to be on payroll for a project. So I would say potentially you won't get the good people that you want, and then be able to, if they're running a business and they've got lots of clients, that they won't necessarily want to do that or go onto an umbrella company. So my view on it, and again, like caveat, check the the whole checklist and get advice, but is if they seem to be set up as a legitimate business, for example, and they've got multiple clients and they've got the contract and all of the business terms, it shouldn't be too much of an issue, so long as they aren't, I think the red flags for this is if they're basic, it's the usual stuff on the checklist, like if they're coming into your offices, for example, you're running, they're working sort of 9 to 5 for you, or those sort of things. If you're just saying, right, you do this part of the thing, this is the contract, this is the terms and conditions, etc., and they've got lots of clients, I think generally it's not such an issue, but you'd want to document that and make sure that that's covered in the contract, both ways. But I would just be hesitant to enforce people going into payroll or through umbrella companies if they're a genuine agency, freelancer, etc., because it's just such a, my perception of the people that the freelancers, they don't want that, the reason they work like that is because they don't want to be on the payroll, essentially because they don't want to be in a job. But that's not necessarily all people, and it might be appropriate sometimes to to hire roles for this as well. It's not saying it's not, that's just my take on it, is you might lose talent by doing that.
Fantastic. Can I be heard? Okay. The whole history of IR35 was in the early 2000s or 2020s, where you had people who were coming in regularly, working normally, but they were taking home the pay of a contractor. Now, the difference between a contractor and a PAYE is PAYE, depending on how much you earn, almost 40% of your income, you only take home around 50% of your income, right? 55. Whereas a contractor, on the other hand, they're more flexible and have more control over the amount of taxes that they pay. The taxman saw this and decided, hold on a minute, you're taking money out of our pockets. And so what they're trying to do with IR35 is identify those that should actually be in employment and those that are trying to be a contractor. Now, I think it's HMRC side, they have this test, is it the CES test or so, CES test, and they ask you a series of questions, right? And ultimately what they're trying to find out, I think it's these questions consist of about 3 or 5 topics. three of them come to mind. I know one of them is, do you have a level of control? So do you have a control over working from your own laptop? Do you have to come into the office? Do you work over in your own time? The other one is, do you have, the other one I think is substitution, which means can somebody come in to replace you? If you do this test and it comes back at IR35, that you're inside, then ultimately they're going to put you on a PAYE. So ultimately, to answer your question, if you put them through this CESS test, ultimately it will let you know where they stand. Ultimately, if you look at some of these criteria, I know there's mutuality of obligation as well. You would have some kind of inclination whether they should be inside or outside IR35, to be honest. If you have a contractor, for example, and they work throughout the night, but their job is just to deliver the work to you, then they're likely to be outside. So you can pretty much tell that, but if you're not sure, please, I encourage you to do the CESS test, and it will let you know where they fall in, whether inside or outside IR35. Thank you.
It's a good point. Thank you very much. By the way, for this CESS test, can contractors do that test to see whether they fall inside or outside? Does anyone know
Yes.
that? They
Yeah,
can. Okay.
that's the purpose of the CESS test, is to know whether you should be
No.
inside or outside IR35.
Yeah, no, I thought that might be for the actual employer, i.e. the company, rather than a contractor. But yeah, that makes sense. Thank you, Samuel. I think we've got Sophie last, isn't it?
No, I went first.
I'm sorry. Okay, I think we've had everybody. Harriet, Andrea, Sophie. Okay, yeah. All right. Okay, we've got 16 minutes to go. Hopefully we'll be able to go through a couple more questions. Just a quick reminder to those of you that are here on Microsoft Teams, if you've got any questions on your business finances, and they can be on anything to do with startup finances in the UK, whether it's cash flow, budgeting, profit and loss, payroll, employee benefits, taxation, bookkeeping, VAT, loans, banking, fraud, projections, forecasting, you name it, we'll answer it. Now, no wrong questions and no need to be shy. Simply drop your question in the chat. We'll then give you the mic, and then you can fire away with your question. If, however, you are on the live streams, please remember that we are unable to monitor your questions there live. So if you've got any questions, you'll need to be here with us on Microsoft Teams. Quickest way to do that is to go to our website, startup2scaleup.club. You scroll down a little bit, you'll be able to find today's session, which is Startup Finances Q&A 08. Click join, it's a quick registration. That gets you a link to your email, and through that link, you can tune in to our session. Once you're here, being audio only, it means you can join from anywhere via any platform or device. Simply drop your question in the chat like Jasmine did just now, and we'll go to Jasmine in a second. And then we'll give you the mic. You can introduce yourself and fire away with your questions. Now, as far as questions on other matters, i.e. outside finances are, please save them for the other conversations we run. On Mondays, it's talent. Tuesdays, product and tech. Wednesday's growth. Thursday's fundraising. Second Friday of each month, it's UK startup law. And third Friday of each month, it's UK startup finances, as you can see today. All from 12 to 1 p.m. UK time. You can register to any of them, again, via our website, startup2scaleup.club. And when you're there, perhaps why not join our WhatsApp community? We've got some groups of founders, investors, operators, and our brilliant panelists. Now, you sent quite a few questions, Jasmine, but if there's a chance to maybe, can I bring it all together, or can I the most important one? But I've given you the mic. Are you audible?
Yeah, hello, yes I am.
Hi, please introduce yourself and then fire away with your question.
Yeah, thanks, Anton. Hi, everyone. My name is Jasmine. I'm currently looking to start a business in the next few months. I've said this like 5 times. I'm like, well, what have I said before? I am quite curious about sort of the financial side as I'm beginning to plan sort of the launch of my business. So I guess my like if I were to just pick 2 top questions, it would probably be sort of the first question about an emergency fund, and the second question, which would be for like the third one that I sent, which is about the tax and financial documented purposes. What sort of would make more sense in terms of when I'm pricing my services or products to clients? Because there's 2 ways I could do it. I could sell them a package, which is just one price, or I could basically work with them through a contract, and then I would say they could have a commission of my profits. Which would it be more difficult to sort of report this as a sole trader later down the line? So yeah, those two questions.
Oh, good call. Thank you very much for that, Jasmine. Let's go on to Samuel, Harriet, Sophie, and Andrea, please.
Hi, sorry about that. I was talking, I was muted. Jasmine, thank you for your question. So I think if I heard right, you're thinking about what tools, accounting softwares that you can use. I think that's the second part of your question, and there's quite a number of them out there.
There's a Samuel. There's a few questions, but if I got it right, Jasmine wants to know about the. Is it the financial buffer, Jasmine, right? The 2 questions, and the other one is the pricing. Is that right, Jasmine?
Yeah, but I mean, the accounting systems might be a part of his answer, so whatever you'd like to answer, feel free to take it away.
All
yeah.
Right. All right. Fair enough.
Fantastic. Yeah. I was going to say Xero, QuickBooks. There's many out there, but honestly, I don't mean to be old school, but being that you are starting off, a lot of this can be done on a spreadsheet initially, because assumptions that you may not have a lot of transactions you're working with. Then, as a startup as well, every cost matters. So taking Xero, QuickBooks, depending the level you want, it's not always cheap for a startup. In terms of financial buffer, it really depends when you do your financial model. I think only then you can determine what needs to be done. I hope your suggestion of a financial buffer isn't linked to a fear factor that you're going to business, because one of the first things you said is that you've been procrastinating for a while now about going into business. But it will be difficult for me to actually give you a concrete figure or amount or percentage that you should have as a buffer until when you actually sit down and do some kind of a forecast to determine what you need to scale this business as well. In terms of pricing as well, there's many ways that you can price. Many clients I know have a tendency, it's not what I would always recommend, but they do look at the market to determine or to base their products off. You can do it based on something high value is results or value add-in prices. And so we don't charge by the hour or how long we take to do. We basically charge based on the outcome. And that changed our pricing strategy once we began to look more at value than on an hourly rate, right? So that's my 2 pence to your questions. I hope I've been able to answer them to some level.
So I'd say in terms of the financial buffer, you mentioned that you haven't started yet. You're just about to start, and possibly starting sole trader from what I've seen at the moment. And so what I'd say here is what's important really is your almost like protecting your financial position. So for example, and I don't know if you've got an income stream at the moment, if you're in a job, or like the background to this, but you need to kind of as we just mentioned about sort of modeling, particularly like your income and outgoing. So how much, for example, do you need to draw money out of this venture from month 1 can you afford to, you know, pay your own bills and have this thing ticking away and maybe not be revenue generating for a number of months or whatever in the background? So there's one thing is looking at your own financial needs and making sure that you've then got enough months coverage for maybe where the business isn't going to be revenue generating. Maybe it is straight away, I don't know, depends what it is you're doing. And then in terms of, that's your financial position, and then you might be running things quite lean, but you might also have outgoings and bits and pieces. So you need to make sure you've got enough funds then to cover perhaps a number of months of bills for the business, so that you can comfortably still cover them even if the income was to drop. Now, sometimes we talk about, you know, 3 months, 6 months, whatever. The reality is when you're in early stages, a lot of people are running more, you know, month to month. They haven't got the ability to hold lots of cash to do that. But it's also a very personal decision of like, what makes you feel comfortable? Is it having 10k in the bank? What does that translate to? And thinking about that as well is what gives you, I think we alluded to on the last person as well, just saying like if is there some fear around that, etc. And in terms of your sorry, I've talked a bit, so I'll try and keep it a bit more brief on the pricing model one. I would say, so, you know, so this is people that you are, they're working with you, and yes, so sometimes you might do a commission, which would usually be based on revenue. So for example, if it's some sort of, the one that's coming to mind is events. So for example, this might be completely inappropriate for what you're doing, but imagine you put on an event. You could say to the people that you need to collaborate with for their services, you could say, let's go into this, you know, I'm running the event and I'll give you a percentage of the revenue we take, for example. That might be a method, and you'd need to document that, and then that's going to be okay for tax because you've got it documented in terms of invoicing them then for, or the, you know, for that agreed slice. You'd want to have it in the contract and that sort of thing to protect each of you. How attractive that is to them is probably how likely it is to generate the revenue. I mean, sometimes it's based on profit, but I'd say it wouldn't be profit overall of the business because there's so many variables of what's going to be expensive, especially if it's your first year. So I'd say probably you would want to do just like profit of the specific activity that you're doing. But it might be that it's more straightforward to just say this is the price. I'm guessing maybe it's a cash flow thing that you'd prefer to then pay them out of the proceeds of it. And again, it's going to be very specific on what the activity is. So that's just a couple of thoughts anyway to get us started. And
just a really quick follow-up question to that. The way I'm thinking about it, and actually it's quite right. I'm actually heading into the event space, so you're very on spot on right there. I would like to, as I'm starting out, I would like to sort of experiment and see which pricing model will benefit my business the most. But the way I'm thinking about it is I either charge them one-off for hiring my booth, and that's how I get the profit, and then they profit from the service being sold. So it's a photo booth box where the image is basically like a portable photo booth box where the image gets taken and then it prints out the picture instantly. So then the customers who pay for the service, then they would be the ones paying them. So I would be getting paid the hiring fee of the photo booth box. That's one way. The second way is the commission way, where basically I say upfront, you know, I don't need to charge you anything, so that it's not a risk to the customer, to the client, sorry. And then instead they can benefit from the commission model, which is basically I, you know, sell the service in their event, and then let's say it's £3.50, they might get like a 10% commission off of however much I profit off of that business. Does that make sense? So my sort of follow-up question, since I'm clarifying this now, is that like, would it be like a bit too ambiguous from like a taxing perspective if I were to trial 2 different types of business contracts for 2 different ways, and then I had to report that? Would that be an issue for HMRC, or like, is that okay? Because I'm not really sure how I want to go forward, if that makes sense. Yeah, that's it.
This is Sophie. it's interesting that you say that, because actually I just wrote down in my notes as you were talking to try both ways. I think especially you're just starting out, and it's the learning curve is going to be huge. You don't know what's going to work, what's not. I would try one each and see how it is. Maybe one is ridiculously admin heavy. Maybe I don't know. Maybe one is more profitable than the other. But I mean, I think that's fine with HMRC. I don't think it doesn't. Yeah, you could sell shoes on the side. It doesn't matter which way. It doesn't matter. Yeah, I think that would be fine, and I think it's a good way to do it. Yeah, I mean, to add anything, everyone had great advice, but in terms of systems, if you did want to go for an accounting system, I'd say Xero, and there is even a sole trader. Like there's all these different levels, and the lowest one I think is £7 a month. So you could do something that just might help, especially with the events. You might find you have kind of high transactions quickly. So I think that would be a good thing to do. And yeah, with a buffer. I mean, I usually recommend companies have kind of 6 months for run rate. So you can, if you lost all your income, you can pay your suppliers for 6 months. But I think it was Harriet saying, you're in a different situation where actually just starting out, you haven't got the income yet, and actually you need to look at your personal situation. So I just agree with everything that was said there, the advice you got from the other panelists. I don't think there's anything else I can add, really.
Thank you very much. And I think Andrea's last this night. Andrea?
Yeah, pretty much what everybody else has said. But the transition from sole trader to limited, I mean, as a firm, we've worked out that unless you're having 35k or more in profits, there's not really that much tax difference. So for financial perspective, unless you're earning above 35k in profits, then you might as well stay a sole trader. Rather than converting to limited, which comes with more restrictions and more work for you as a business owner. So yeah, unless your profits are above 35k, stay as a sole trader.
That's an interesting observation you make, Andrea, and I hear this a lot from accountants. I, on the other hand, when it comes to startups, have always been a fan of moving to LTD from ground zero, literally from day one. I'd love to hear from the others as well. What is your thoughts in terms of startups, not other businesses, but in terms of startups? What's your view between starting as a sole trader or starting as an LTD? Maybe just a quick fire, kind of 30 seconds each, because now I know it's 1 o'clock. So maybe if we go to the others first and then come back to Andrea again on this. So let's say Sophie, Harriet, Samuel, and last but not least, again, to Andrea on this.
Yeah, I don't deal with sole traders at all. And so I don't have a whole lot to add. The only thing I would say, I guess, is, if you're starting out, and you, as part of that, you have quite a lot of purchases to buy, things to buy, you might want to just be it might be worthwhile to register as a company and also register for VAT, even though you're under the threshold, so you can get that 20% back. I'll leave the rest of the others in terms of like tax paying for a sole trader. So I don't really know about that.
Thank you. And then I think we said Harriet, Samuel, and last but not least, Andrea again.
So one aspect to consider is like traditionally sole trader is seen as like less admin and filing and cost. But I just bear in mind that the new Making Tax Digital sort of legislation that comes in from next year, which probably won't affect you for a bit until you're earning a few more profits, but that will involve quarterly reporting, the need for an accountant, and you might then look at the two and say, well, might as well be limited because there's this admin burden anyway. And so that's just something to bear in mind. It won't affect you if you register right now today. It's not going to come in for you in April, but it will come in probably by like 2027.
Hi, Yasmin. I think that honestly, the biggest benefits between a sole trader and a limited company is really around the taxes. But it really doesn't impact a sole trader until when they begin to earn over 40 or 50K or so. And at which point, if you're in a limited company, you can take out a mixture of dividends and salary. So it's definitely more profitable, and there's so much other perks from a tax perspective. The difference right now when starting off in terms of taxes as a sole trader won't be much, but as you scale, you certainly want to transition into a limited company.
Thank you very much. And again, Andrea, anything else to add on that point?
Yeah, I mean, I know there's the whole, when it comes to sole trader versus limited, for us, we just know when they're starting out and businesses are small like that, that the limited costings that we, as an accountant, will charge them compared to them being a sole trader, irrelevant of MTD coming in, is very much different. And also having the responsibilities of being a director. And I just feel that small businesses that are sole traders need to understand the consequences of being a director, and I don't think that's taken into consideration, that there is just more liability on them, even though they are doing exactly the same job, but maybe as sole traders and directors, there's just, I just feel that they need to take it more seriously being a director of a limited company. And when it comes to insurances and all those other extras, things that come out. As far as VAT is concerned, you can still be VAT registered as a sole trader. So you can claim back your VATs and whatever, irrelevant of your turnover threshold, being a sole trader as well as being limited and that. But we always recommend to clients that it's just not necessary to go that full upheaval into being a limited director of a company when your business is so small and only making those profits.
I just really wish we had more time on this, because this is such an important factor to bear in mind. And for me, often, even when I had my own startups, one of the things I always found really annoying is, speaking to potential clients who were going to either buy my services or products. It was about, getting the insurances and all this, and all of these large clients, they didn't want to hear about it. If I was, a sole trader, and the banking was difficult as well. But then you have all these benefits in terms of kind of certain things being easier that you lovely people have mentioned. So it's a tough one, but maybe one for another session. We are now 6 minutes over the line. I hope you found it helpful, Jasmine, and others too, mind you. If you've got time, panelists, for some quick parting words, would love to hear from you. If not, I totally understand. I've kept you here far too long. So, but if you do, maybe we can start with the ladies of the house. So let's say Andrea, Sophie, Harriet, and last but not least, Samuel, please.
I say this every month, but I just feel it's really important that anyone who's starting in business gets an accountant from the beginning of their journey and not wait until their filing's actually due. I just think it's really important that you have your accountant from the day you start, so that they can set you up correctly and make sure you're doing things correctly from the very beginning. It will help in the long run.
I think it was me next. Apologies if I jumped in too quickly. I just say thank you for the questions today, and if anyone's got any sort of thing they want to follow up, then feel free to reach out.
Thank
you. My parting advice is about forecasting, because it's Q4 and people are starting to look at their forecasts for next year. And I would suggest not looking at last year's performance and adding 5% to it, but actually, do what your best case kind of first draft of the best case forecast, model it out, stress test it, think of what your, are there any environmental changes, environmental risks around, political risk, are there new competitors in your market, and really have a good think, almost like from scratch, so that it actually means something and that you can use it rather than just last year plus 5%, which a lot of people do.
Sorry, just before we go to Samuel, Sophie, have you got any articles or any templates that people can, in the first instance, now, yes, ideally they'd want to go to a finance person or an accountant like yourselves here, but anything that they can start with? Have you got anything you can share, maybe in our LinkedIn live stream?
Let me think. I mean, not to hand, but there will be some around. I won't be able to find it in 30 seconds. But
no, you don't have to find it even later. So when you look at,
let me have a think. And
perfect.
Yeah, I mean, we normally do them ourselves, but yeah, let me have a think about that and I can post something.
Any ideas you can come up with on that on the live stream? You'll see I've tagged all 4 of you, so and then just post it under the comments there, if that's okay.
All right.
If you find anything.
Sure.
Perfect. Thank you very much. And last but not least, Samuel.
Hiya. Once again, just want to appreciate you for having me. Honestly, all of what was said, even I found it insightful from the guest here. I would say cash flow is your truth. Cash flow is your truth. Know your numbers and you'll make better decisions. It's that simple. Every single time. If you know your numbers, you won't be operating blindly. You'll be fully informed when making decisions about your business, whether it's hiring, whether it's buying a new equipment. Just keep hold of your numbers. Thank you for having me.
Well, thank you very much to all 4 of you. I'm very grateful for your time and amazing wisdom today. Of course, thank you to everybody else that tuned in, whether you were on the live streams or here on Microsoft Teams. I hope you learn that it's best if you join us here on Microsoft Teams, and I hope you can do that next time. Couple of quick things before my parting words. Number 1, we run 6 regular sessions: Mondays talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising, second Friday of each month is UK startup law, and third Friday of each month it's UK startup finances. They're all from 12 to 1 p.m. UK time, and they're all available on our site, startuptoscaleup.club. Again, startuptoscaleup.club. You can register to any future session via our site. We've got some amazing WhatsApp groups as well you can join, either when you're on our site. At the top and bottom of our pages there, you'll find a WhatsApp icon, or here on our call on Microsoft Teams, I've just dropped in the chat a link to our Startup Finances Q&A WhatsApp group. In terms of my parting words, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime and be kind to yourself as well as everyone else for that matter too. Have a great weekend. Hopefully we'll see you on Monday for Startup Talent Q&A, where you can ask us anything to do with hiring and keeping the right people. We'll have an amazing panel of talent experts. Otherwise, thank you again and God bless you all. Bye-bye for now.